Welcome guys to the next video of this FX program. We're absolutely smashing it now. But this video, we're going to get into trading from a recovery zone in aggressive market conditions. This is actually something that a lot of traders struggle with when they're trading. It doesn't matter what strategy you use. This lesson is going to be a good lesson for you because, yeah, again, a lot of traders struggle with knowing how to operate, how to trade when there's really aggressive movement in the markets. And you don't always have to not trade. If you are unsure how to trade in aggressive market conditions or any conditions for that matter, then the best option is to not trade. That is the greatest option. But this lesson is going to show you how you can possibly trade when conditions are super aggressive and there's a really aggressive movement, and you can take advantage of that. Previous lessons we talked about taking advantage of higher time frame entries and obviously lower time frame entries, that shorter term movement, those reversals, mean reversion. But here we're also going to talk about, we're pretty much going to add on to that, but show more in depth how you can specifically trade in aggressive market conditions. So it's going to be a great lesson for you. Again, this lesson is going to be pre-recorded because it's the exact same trade example from the previous lesson, but explained in a different way. There are more additional tools that you can use to understand market behavior, being able to specifically identify where you can get into an entry when markets are aggressive or overextended, I guess you could say, which we are going to get into in future lessons of this program. So make sure to stay tuned because, again, no matter what strategy you use or whatever confluences that you use, those additional tools are absolutely awesome to use as well in aggressive market conditions, because it really outlines your risk and a good place to set your entry price, if that makes sense. So yeah, without further ado, let's get straight into this video.
Straight onto TradingView. This is the first example of a aggressive trade that you can take in the opposite direction. Now, this trade example I showed you in previous lessons, trading on the higher time frames, but there was actually a lower time frame entry here where it was actually suited to this particular trade. So for those that were scalping and for those that were trading on those higher time frames that were swing trading, then it would have worked out for the both of you. This is on the New Zealand dollar. I'm just going to work my way down from the weekly time frame. So starting from the weekly, obviously we can see that I have this weekly recovery zone marked out here at the top, all of this liquidity that's sitting here. So if price was to keep going higher, this would be a perfect place for price to target. It would take out this liquidity, all of these sell orders that are in here. All of those retail traders would be wiped out and this recovery zone would be filled. So that'd be two amazing wins for the institutions, the market makers. Now, on the daily time frame, I had from this high to this low. So we were bearish. We were following that overall momentum on the weekly time frame. Stepping down again for our bias from the weekly and the daily is still sells. That is our initial thoughts going into the lower time frames. Now on the 4-hour time frame, I have marked this 4-hour recovery zone to the left here. Again, another perfect example, a large amount of liquidity sitting just beneath this recovery zone. Perfect place for market makers, for institutions to target. They'll fill their orders as well as taking out a lot of the liquidity that's sitting there. So again, this is the 4-hour immediate viewpoint, the bearish immediate viewpoint. Price is a little bit choppy in between this internal structure here. And then on the hourly time frame, I have marked this low to this high after this beautiful break of structure. That's where price again reversed as that counter trend trade. Now, also just a perfect example of how well recovery zones price reacts off recovery zones. Beautiful example there where price is overextended, price was stepping up, filled that recovery zone, massive move to the downside. Absolutely beautiful. Now getting back to the trade that is presented here, obviously we are working within this bullish 1 hour recovery zone. We want to be buying for that counter trend trade. We've got a 15-minute recovery zone beneath here. Price has got all this liquidity here, so again, another reason to buy would be in line with those institutions that are wanting to take out those sell positions there, those retail traders. So the overall time frames are bearish. All these retail traders are like sell, 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 sell. That's why us traders, the scalpers, that are thinking like professional traders, we want to be trading in line with the institutions. We want to be able to pick apart the currency pair that we're trading and really dissect it down time frame by time frame, confluence by confluence, and obviously we can see the overall narrative of price action. We can see that most retail traders are selling, they want to be selling, which is perfect incentive for institutions and market makers to take the trade in the opposite direction. So if we can actually identify where they would be making that reversal, where they would be manipulating price, where they would be pumping money in to take out those retail traders, that's where we want to be taking our positions. And this is a perfect example of that. So on the higher time frames, bearish, overall narrative is sells for retail traders. And we've picked the time frames down by time frame by time frame. We've gone from the higher time frames to the lower time frames. We've identified a bunch of liquidity, which is a major confluence. And this is the bullish 1 hour immediate viewpoint. So we're doing that retracement trade within the higher time frames. We've identified a perfect 15-minute recovery zone. Price has filled that 15-minute recovery zone. Moving down to the 1 minute time frame, as you can see here, on that 15-minute time frame, there was a large move to the downside, filling that specific 15-minute recovery zone. In this particular scenario, if you were following, if it was a normal trade, you would actually have to wait for this structure break up here. When I mark this horizontal line, you'd have to wait for that 15-minute structure break to be able to actually take a buy position, because then you would have the 1 hour and the 15-minute in your favor to be able to take a buy position. There'd be more of a confluence, but in this particular situation, we have all these confluences. We have volatile price. We have, as you can see to the left here, all of the moves have been quite aggressive following this consolidation, even over to the left here. So most of the moves in relative days have been quite aggressive, and then you can see this move down here. Now, instead of actually waiting for a break of structure here, which took quite a while, it was a couple of hours until price broke structure here, then you would have to wait for a pullback into a particular recovery zone or to take a buy position. And then obviously stepping down to the 1 minute, 15-second time frames, you wouldn't be able to catch those moves. So moving back down to the 1 minute time frame, you can see there was an aggressive move to the downside, filling this position. You can see that we had a 1 minute break to the upside, and the last recovery zone that was actually in this particular area was right here on the 15-second time frame. This is a 15-second recovery zone. There was no lower recovery zones in this particular range. A lot of people would have their stop loss a lot smaller, but again, you'd be taken out. It's really stupid to have your stop loss that small in this particular situation scenario. So my buy position is huge. Let me just change this, put it back a bit. It was a 5 pip stop loss. So That's usually as small as I get with my stop losses, maybe a 4 pip stop loss at most, but it also depends on the volatility in the market, how much volume is in the market, because obviously the candlestick sizes are going to be different, and you'll start to notice that when trading other currency pairs. But getting back to this trade, that was the buy position that I placed on that 15-second recovery zone. Again, when you're taking these trades in aggressive conditions, you have to be a little bit more in tune with your take profits. You can't be as greedy. You can't target as long like you would on other trades as continuation entries when all the time frames are in your favor and you've got all these confluences. That's when you can have bigger take profits. But because one, this is a counter trend trade, two, you're trading in aggressive market conditions. So again, that's two risky setups that are correlating with each other. Yes, we still have a bunch of confluences for price to go in our favor, but you just have to really, these are the trades where you have to sit there and actually really monitor price. You have to be a little bit more strict with where you take your profits, like I said before, and the different risk factors that are currently presented in the market. So, for example, in this particular position, after this massive move, you'd be looking at areas like this. Just say, for example, even if you did have to take your position off at 2% in your favor, you're only up 2% in profit. Maybe place your position at break even, so then there's no risk on the table. It's a very good idea to do that. A part of being a good trader is protecting your risk, not just making profit. Because if you made all the profit in the world, but you had nothing protecting your risk, you wouldn't make anything. So, and also major key levels, because if the overall narrative is sells and price action is in that bearish favor, the overall market is bearish, then the key levels at the top here, the lower highs, they're gonna hold more support than if it was in a bullish market, obviously, because price wouldn't necessarily be looking to surpass that lower high because it's in bearish market structure. But in this particular example, on the 1 hour time frame, we are bullish, so you can target this particular high, because on the 1 hour, the incentive is saying that price is wanting to do a retracement. It's bullish, so price is obviously going to surpass this high. It doesn't have to, but that's what it's indicating in that particular time frame. So you just have to pick apart your trading pair, whatever you're trading. Doesn't matter what currency pair you're trading, but you really have to dial in all of your confluences and all of your risk factors and weigh them up together. And this is what I mean by you have to have them predetermined before you actually enter your position. So you need to know your risk factors, where there's possible risks in the particular market structure or recovery zones and balances, liquidity. It could be news events, a range of other things. It could be rolling into a different trading session. Whatever it is, you need to have them all predetermined and then enter your position. So in this particular example, I didn't actually enter this trade. This was a trade that I took on the higher time frames. This is just an example to show you what an aggressive trade would look like in this particular setup. So no, I didn't actually place this trade in real time, but as I placed this trade on the higher time frames, I did notice that it's also an aggressive trade setup and a counter trend trade setup that you could trade in the opposite direction. So I hope that makes sense. I will show a couple of more examples of that particular setup, because again, a lot of traders really struggle with knowing where and when to trade in those type of conditions. Most traders would be like, nah, I'm not trading, or they would be trading in the opposite direction, in line with all of the liquidity, which is not good. We don't want to be in that particular scenario, because all of the market makers and the institutions are trading in the opposite direction, and most of the volume in the foreign exchange market is made by those major market makers and big corporations. So obviously we want to be in line with that volume.